You're hearing one story about Florida, but the numbers tell another. Behind the booming population headlines, the gears of the housing market are grinding and the people on the ground are feeling it first. The shocker? Even Florida's own leadership is admitting the math doesn't work for regular buyers anymore. Let's start with what looks like good news and then pull back the curtain. Florida added roughly 467,000 residents between July 2023 and July 2024. Big number, but the composition changed completely. Domestic migration, Americans moving from other states, collapsed to about 63,000 in 2024, down from over 317,000 in 2022. That's an 80% cliff drop. Meanwhile, about 88% of net growth now comes from international migration, a level that historically sat closer to a third. Why does that matter? Because Florida doesn't control that lever. Washington does. If federal enforcement tightens, that growth engine sputters. Even the state's demographic estimating conference put a foot on the brake in June 20, declining to update population models because of emerging and evolving immigration policy changes. Translation uncertainty just became a forecast variable. Zoom in further and you see a new pattern. Florida now has net negative household exchanges with Georgia, North Carolina, Tennessee, and Texas. More people are leaving Florida for those states than arriving from them, and the ones leaving skew younger, 20 to 29. Exactly who fuels first-time home buying? Florida's own governor acknowledged it's become expensive, that young people starting out are getting boxed out, and that even he wouldn't be able to afford a modest starter home if he were beginning today. When the person running the state is telling you affordability is broken, believe him. Now to the second fault line: institutions. For years you heard Wall Street is buying all the houses, but look at what they're doing now, not what they did then. The largest single-family rental owners, Invitation Homes, Progress Residential, American Homes 4 Rent, First Key Homes have been net sellers for multiple quarters in a row, and Florida investor purchases are down across major metros. Miami off nearly 20% year over year in Q1 2025. Orlando down double digits. Fort Lauderdale, West Palm Beach, Jacksonville, all lower. Only Tampa eked out a small positive. Condo invested a 10-year low across several metros. These firms have cheap capital and deep data. If they're quietly heading for the exits, they're telling you the risk-reward changed. The twist is that while institutions pull back, the legacy of cash-heavy buying remains. Miami still sees roughly 30% cash purchases. West Palm Beach approaches half. In markets where 1 out of 3 or 1 out of 2 buyers are paying cash, mortgaged buyers are swimming upstream. Now layer on affordability. Statewide median price sits around $410,000, with Miami near $507,000. Prices ticked slightly down year over year, but that doesn't fix the payment problem. At today's mortgage rates, the income needed to afford the statewide median, roughly $98,000 to $100,000, with 20% down, is about 28% higher than Florida's median household income, around $77,000. The affordability indices in several counties are well below 100, meaning the median family can't carry the median home without stretching. Payments for the same price point are up roughly a third versus 2021 purely from rates. So even if prices fade a bit, the monthly is still heavy. Insurance, still painful, though the trajectory finally improved. Average homeowners' premiums run materially above the US average and can be jaw-dropping on the coast. But after years of double-digit hikes, 2024 brought a near-flat average change in Florida, while many other states took big increases. Litigation dropped, new carriers entered, citizens shrank. That's progress. Still, the baseline is expensive, and affordability is a monthly payment problem. If your principal and interest are high and your insurance is high, the total is still high. And then there's the condo time bomb. Post-Surfside legislation forced structural inspections, reserve studies, and mandatory reserve funding. Right policy for safety, but the bill arrived all at once. Associations are raising fees aggressively, levying special assessments or seeking loans. We're seeing $1,000 plus monthly HOA increases, and 5 to 6-figure assessments that many owners simply cannot pay. Prices in several condo markets are softening as buyers price in ongoing costs and potential liabilities. Even with relief measures that let associations pause certain reserve contributions temporarily, the repairs still have to be done, and somebody has to fund them. What does the market look like in the trenches? Inventory is up sharply. Florida now represents a disproportionately large share of active U.S. listings relative to its population. Months of supply is edging into buyer's market territory in many metros. Mid-5s for single-family, statewide higher for condos, and even higher in certain cities. Days on market are up. Far fewer homes sell above list. Price reductions are more common. The psychology flipped from FOMO to prove it. So is it a crash? Not what we see. It's a correction. The air coming out of a stretched affordability balloon. More inventory. Slower absorption, softer pricing pressure, but not wholesale capitulation. And remember, cycles don't turn on one lever alone. Affordability improves via some combination of lower rates, lower prices, higher incomes, or lower carrying costs. Right now you've got small relief on insurance and a touch of price softening, but rates and incomes are the swing factors. Practical takeaways for Florida. Buyers, you have leverage you haven't had in years. Negotiate price, credits, and repairs. Push for seller-paid rate buydowns if you're financing. Avoid older condos unless you've read the reserve study, pending assessments, and scope of repairs line by line. Underwrite taxes, insurance, HOA, and special assessments to a worst case, not a hope case. Sellers price to the market you're in, not the one you miss. If your home is sitting, the market is telling you something. Respond in weeks, not months. Consider offering credits for rate buydowns. It's often cheaper than a bigger list price cut and solves the buyer's payment problem. Investors, cash on cash matters again. Underwrite insurance as a rising line item, not flat. Stress test rent growth to conservative levels. If institutions are net sellers in your submarket, ask why, and don't ignore what their exit says about forward returns. For condos, be extremely selective or wait for post-assessment stabilizations. Now let's widen the lens and head west to Texas, the real estate giant of the South, where 2025 brought its own reset. Median prices in Texas are down roughly 3% year over year to about $331,000, still below the national median, but the bigger story is inventory and time. Active listings are up more than 30%, and the average timeline from list to close is stretching to around 100 days plus. The frenzy from 2020 to 2022, when relocations, cheap money, and low taxes turned weekends into auctions, evaporated as rates camped near 7%, affordability became the ceiling. The psychology flipped. The new norm, seller concessions, rate buydowns, closing cost credits, and patient buyers. Importantly, this isn't 2008. Texas didn't massively overbuild, job growth remains solid, and population inflows continue. This is a repricing of payment risk. A $330,000 home at 3% once cost around $1,400 a month in principal and interest. At 7%, it's well over $2,000 before taxes and insurance. That delta takes buyers off the field until price or rate adjusts, or both. Insurance is the stealth headwind. Along the Gulf and in severe weather corridors, premiums are up 20% to 40% in places, and coverage is tightening in flood-prone zones. That extra $200 to $300 a month can wipe out the effect of a modest price cut. Add in lenders boosting escrow reserves, and you get slower, jerkier deal flow and occasional micro-freezes, brief pauses tied to Fed hints or storm-driven underwriting halts. Texas is a tale of submarkets. Austin's tech-heavy, higher-priced segments took the largest hit with mid-single-digit price declines as luxury inventory lingered. Dallas, Fort Worth is mixed, some suburbs down, others stable thanks to corporate growth. San Antonio slipped modestly as taxes and insurance offset its value proposition. Houston held up better on jobs, but its insurance and flood dynamics still bite. Meanwhile, mid-sized cities like Waco, Tyler, and College Station are quietly steady, drawing remote workers and retirees who want price, pace, and predictability. What's next in Texas? Baseline expectations call for flat to slightly lower prices into late 2025, with a possible firming in 2026 if rates ease. The state's fundamentals, jobs, migration, pro-business policy, remain intact, but the new Texas playbook is patience, precision, and pricing power. Practical takeaways for Texas. Buyer's inventory is your friend. Don't chase. Use seller credits to buy down your rate. A 2-1 buydown can make year 1 and 2 livable while you wait for permanent refinancing options. Shop insurance before you go under contract, not after option period. In flood or hail corridors, assume premiums rise. Seller's time will cost you more than a price cut. If you need to move, use concessions strategically. Rate buydowns often outperform list price reductions in attracting financed buyers. Ensure your home is inspection ready. Small repair credits can save contracts from dying in week 4. Investors, this is a selective buying window. Focus on boring, cash-flowing assets in landlord-friendly jurisdictions with strong school districts and diverse employment bases. Underwrite with higher insurance, conservative rent growth, and today's debt costs. Newer construction with efficient systems can beat vintage stock weighed down by capex and rising premiums. Back to the bigger picture. Florida is correcting under the weight of affordability, insurance, and a condo compliance shock, amplified by a shift from domestic to international migration. Texas is normalizing after a frenzy, a payment recalibration driven by rates and insurance. Neither market is over, both have simply changed regimes. If you own, optimize your carrying costs, refinance opportunistically, and hold through noise if your time horizon is long. If you're buying, your edge is discipline. Know your numbers better than the seller does. Negotiate hard and walk when the math doesn't pencil. If you're investing, Follow the institution's footprints, not their press releases, and don't fight the spreadsheet. Yield is a function of price, payment, and predictability. We're in the separating phase, where smart money tightens criteria, and the rest chases headlines. Don't chase headlines, chase cash flow, durability, and downside protection. The frenzy is gone. The fundamentals are back. And that's exactly where disciplined operators win. If you found this breakdown useful, tap like and subscribe so we can keep bringing you data-driven deep dives. Drop your Florida and Texas red in the comments. Which submarkets are holding up, which are rolling over, and where the real opportunities are hiding right now.